Back to the overall markets. Jonathan Golub, Credit Suisse chief equity strategist, is with us now. All right, Jonathan, I'm going to confront you.
Okay.
Okay?
All right.
Look, in my opinion, looking at recent market action, I feel this market just wants to go down.
You know, does it right now feel ill at ease? Maybe. But I do think that we're overreacting to this threat of trade war and some of these other headlines. The reality is that we're probably not going to end up in a full-blown trade war. This is the way that Trump is negotiating these things, and I think that the market probably in a month or two from now is going to realize that worst-case outcomes didn't play out, and we're left with a very good economy.
Well, look, I think you're right to take a slightly longer-term view. We shouldn't be reacting to day-to-day events, up today, down tomorrow, what's the reason? I take your point, but your outlook relies on profits continuing to go up very nicely, the economy continuing to expand very nicely.
And it will. I mean, the expectations are between something like 18 or 19% earnings growth this year, of which about half of that is from the underlying strong economic trend, and half of it is from the benefit from taxes and also the fact that you have better economics coming from this tax and spending bill.
Wait a minute. Profits this calendar year, 2018.
S&P EPS.
Profits
are supposed to, and this is Wall Street consensus among analysts, is something around 18 or 19%.
Compared to last year?
Compared to last year.
That's a huge increase.
It's a massive increase. And of that, about 7% of that is just straight in the way. You take corporate profits, you put a lower tax on it, and you're left with a bigger number. So that's the biggest thing. And the second issue is that the economy is in really very, very good shape. So this year, we're expecting an economy, and I say it's us at Credit Suisse, but it's also the broad view of GDP almost 3%, which is better than we've seen in quite a while. And some of that will spill into above average in next year as well.
You know, Jonathan, you're making a lot of sense, and my confrontation obviously failed, but I'm going to try it again. How about the tech stocks? It seems to me they just want to go down from their astronomical valuations that we saw in late January.
All right, so I'm going to challenge you on this one again.
Go ahead.
So tech has gone up way more than anything else throughout this entire recovery for 9 years. The issue, though, is that we confuse a stock price going up with the stock that's getting more expensive. The earnings on these companies have been absolutely brilliant, and they've delivered far more earnings than anything else. So there are other sectors that, let's say, like consumer staples or energy, that are expensive that their prices have gone up, but not driven solely by a better earnings. So I think that these things are probably closer to fair value.
On your screen right now is Facebook at 166, down $2.69. Do you think their earnings, their profits are going to go up?
You know, listen, I'm not going to comment on a given stock. I'm not the analyst on Facebook.
That's right, you're not allowed to.
But here's the reality. There are news headlines that right now are making, that make investors uncomfortable around the tech space. But when you get beyond that, yes, these companies are expected to deliver fantastic earnings in 2018 and 2019.
You know, I'm not going to give you game, set, and match, but I think it's 15 love to you at this point. Right? Jonathan Golub, thank you very much, sir. Appreciate it.